All right, welcome to this explainer. Today, we're cracking open the AI investment memo on an absolute cultural giant, Universal Music Group. We are talking about the powerhouse behind the biggest names in music. Literally, a company whose catalog is effectively the soundtrack of our lives. But look, we aren't here to review their latest platinum records, right? We're here to look past the hype, get under the hood, and evaluate UMG's actual financial health and whether it makes sense as an investment.
Because it brings up the ultimate investor's dilemma. You've got a legendary cultural footprint and a massive, seemingly impenetrable moat, but does that automatically equal a winning stock for your portfolio? Well, spoiler alert, the answer isn't as simple as just buying what you stream.
So, here's a quick roadmap of what we're going to cover today. We'll start with the background, then unpack their toll booth moat, examine some serious concentration risks, follow the money, tackle a pretty big governance problem, and finally, we'll deliver our verdict.
Okay, let's jump right into Section 1, Background, UMG's Rise to Power.
To really understand UMG today, you just need to look at a few critical moments. Back in 2011, under CEO Lucian Grange, UMG made this incredibly decisive move to acquire EMI's recorded music. That radically expanded their catalog depth. Jump to 2020, and a Tencent-led consortium validated their massive valuation by grabbing a 20% stake. Then came the big one, the 2021 spin-off from Vivendi, which finally put a public price tag on the stock. And most recently in 2024, they showed they are absolutely not afraid to flex their muscles. They actually pulled their entire catalog from TikTok over compensation and AI concerns before hammering out a new deal. Basically, they've entrenched their position masterfully.
Moving right along to Section 2, the toll booth moat, scale, and leverage.
Now, what's really interesting about this slide is that UMG isn't just making music. Oh no, they are operating a highly lucrative distribution toll booth. Think about it. They're a scaled entity sitting directly between the artists creating the art, the platforms distributing it, and the fans consuming it. If you want to move music from point A to point B on a global scale, you're paying the toll.
And this moat is built on three massive pillars. First up, unmatched catalog breadth. Nobody has what they have. Second, a global artist development infrastructure that smaller independent labels literally just cannot replicate. And third, immense bargaining leverage with digital service providers or DSPs like Spotify and Apple. Because UMG controls so much essential inventory, they get to dictate the rules of the road. But that brings us to Section 3, concentration risks. Who holds the power?
Because here lies the hidden vulnerability. If we look at the breakdown, just three major digital platforms make up roughly 42% of UMG's entire revenue. I mean, that is massive concentration risk. Yes, the platforms desperately need UMG's music, but UMG is fundamentally dependent on just a handful of gatekeepers to actually reach the listeners. It's a mutual dependence, not total unchecked dominance.
And compounding that risk is a rapidly shifting landscape. You've probably noticed this yourself. Consumer attention is increasingly migrating away from premium, high-margin subscription streaming and moving toward lower monetizing, short-form video platforms. Think TikTok or YouTube Shorts. Organic, pure streaming growth is stalling out a bit as our attention fragments into these formats where it's just much harder for UMG to extract top dollar.
All right, Section 4, following the money, the disconnect. When we look at the financials, the trend here is what really matters. Sure, revenues are steadily climbing year over year, moving from over 11.8 billion euros up past 12.5 billion. But look at the adjusted EBITDA margin. It is completely, stubbornly flat at 22.5%. So despite getting bigger as a company, their profit margin isn't expanding at all.
So why is that margin stalled out? Well, it clarifies a crucial reality for us. This isn't some frictionless software business where every new subscriber equals pure profit. No way. UMG faces fierce competition over top talent, and that leads directly to rising artist costs and much higher payouts. You add in shifts in the repertoire mix and higher merchandising expenses, and you start to see that every time they grow, a large chunk of those new economics is immediately competed away.
Which leads us to Section 5, the governance problem, trust and capital. 41.1 million euros. Let that sink in for a second. That was the CEO's total remuneration in 2025. When you combine this incredibly rich compensation package with very complex accounting metrics and severance terms that actually exceed Dutch corporate governance guidelines, well, you start to really test shareholder trust. The reporting is messy enough to support a lot of different interpretations, and honestly, that's a red flag for a stock priced at a premium.
So, the crucial point is, UMG's stock currently offers a sub 2% free cash flow yield.
When a company's valuation is this incredibly high compared to the actual cash it generates, things like share buybacks, they just don't mean much, because management is basically buying back very expensive stock. It leaves investors with virtually zero margin of safety if growth slows down even a little bit.
And that brings us to Section 6, the verdict, the final call.
We have to clearly contrast the two realities going on here. On one side, you have the asset. Make no mistake, UMG is an exceptional business with a world-class moat, unmatched global scale, and a cultural footprint that just cannot be replicated. It's a fantastic company. But on the exact opposite side, you have the stock. And the stock carries a massive premium valuation, real governance friction, and undeniable margin pressure.
Which brings us to the definitive takeaway from our source analysis. Quote, "The business deserves admiration. The current risk-reward does not deserve fresh capital." In a skeptical investment framework, the bar for committing new money to a premium price stock is extremely high. And right now, UMG simply doesn't clear it.
So I'm going to leave you with this final thought to ponder. What must UMG do to earn our capital in this next era of streaming? Are they going to prove they can truly expand those margins? Will the valuation finally come back down to earth? Until those changes happen, the smartest move is to admire the music but hold off on the stock. Thanks so much for joining me on this explainer. Keep analyzing, keep questioning, and we'll catch you next time.